Hey traders, welcome back to another quick guide on navigating the Indian stock market. Today, I'm diving into how you can predict a volatility crush post-earnings or major events. First, let's break down what a volatility crush is. Essentially, it's the rapid decrease in implied volatility of a stock after an earnings report or significant event. This often leads to a sharp drop in option prices, which can either be a blessing or a curse, depending on your strategy. Now, how do you predict it? Let's take Infosys as an example. Infosys, like many large cap stocks, sees a lot of action around earnings reports. Before earnings, the implied volatility, or IV, usually spikes as traders anticipate big moves. But right after the earnings announcement, if the results are in line with expectations, the IV can drop sharply. That's your volatility crush. To anticipate this, keep an eye on the historical IV patterns of the stock. Infosys, for instance, has shown a consistent pattern of high IV before earnings and a drop right after. By studying past earnings cycles, you can gauge how the market might react. Another tool in your arsenal is the options chain. Check the IV levels of at-the-money options expiring just after the earnings date. If you see elevated IV compared to longer-dated options, it's a signal that a volatility crush might be imminent. Also, pay attention to analyst predictions and market sentiment. If analysts are aligned and there are no major surprises expected, the likelihood of a volatility crush increases. So, how can you play this? If you expect a volatility crush, consider strategies like selling straddles or strangles before earnings. Just remember, these strategies carry significant risk if the stock moves sharply. And there you have it, a quick and practical guide to predicting volatility crush in the Indian market. Remember, always do your homework and consult with a financial advisor before making any moves. Happy trading!